All right, so let's begin. Stay invested for long to create wealth. You must have heard and read a lot of investment gurus and pundits say that. But what exactly is long term? Is long term different for each asset class? And how has various asset classes performed as per their definition of long term? Let's get into the details of this. I have with me Niranjan Avasthi, SVP and Head Products Marketing Digital Business at Edelweiss Mutual Fund. Niranjan, good evening and welcome to the show. Let's decode this funda of long-term investment, okay? Because you need to stay invested for long in order to create wealth. Okay? We all understand the statement, but when it comes to implementing this in various types of investment instrument, what exactly would be the definition of long-term?
Thanks, Kavita, for having me. This definition of long-term has been debated for long. And I've seen people when we are in a good market, especially for equity, when we are in a good market, last 3 years returns are very good. A lot of discussion is that long-term is 3 years. Exactly reverse when we are in a bad market, when last 3 year returns are not good, then the long-term definition shifts from 3 years to maybe 7 years and 10 years. So I've seen people shifting this definition right from 3 years to 10 years, depending where we are in the market and how the past returns are. But actually, technically speaking, for any asset class, a long-term period is defined as a period where the risks are commensurate or risks are slightly lower and the rewards are slightly higher for that period, which means is the probability of making negative returns for in that particular period is lower for that asset class, and that period becomes a long term. So for each asset class, technically we need to see how they have performed across cycles and across periods. Specifically, what are the instances where they have gone negative, and accordingly define long term for that particular asset class.
All right, Niranjan, one aspect of maybe playing the duration game or maybe aligning your investment horizon or your investment goal with a particular duration. What kind of a risk profile one has to assess and understand from an investor's point of view in order to be aligned with the right kind of investment product? I mean, that's the crucial planning that an investor needs to do from their end.
Absolutely. So once you figure out that it's basically a two-way process. First, you have to see for what period you want to invest. If you want to invest for maybe 10 years, now in 10 years, what kind of risk you want to take on your capital. Once you get answer for these two questions, then you have to assess, okay, for 10 years, which is the asset class which fits in my risk return profile. So if you're investing for 10 years and you're okay to take risk or intermittent risk or volatility in the investments that you make, then maybe equity is the answer. If you're investing for 10 years, but you don't want to take risk on your capital, then maybe debt is an answer. Or you want to take a moderate call, then maybe a mix of debt and equity is the answer. So as you rightly said, assessing your own risk appetite, your own investment horizon, and then understanding the asset class and the risk. You have to marry all these three and then figure out which asset class is good for you. So everyone talks about like equity is good for 10 years, but is it good for you is an important question. And that answer will come when you assess your own risk appetite, how much you can risk your own capital, and what is the period of investment period that you are looking to invest.
Niranjan, one basic or a common mindset among investors is long-term and short-term time horizon is mainly dependent on the tax implication that's applied on the investment instrument. Is that the right way to look at it?
Not at all, Kavita, because we live in a world where till recently the taxation or the long-term capital gain tax for debt was 3 years, and for equity we know it is 1 year. So for equity to qualify for long term, it is 1 year. For debt, it was 3 years. Doesn't mean that 3 years is long term for debt and 1 year is long term for equity. It is probably the reverse. For equity, it is much more than 5, 7, or even 10 years. And debt, it could be even 2, 3 years, depending on which debt fund you are investing in. So definitely taxation is not the anchor or not the factor to decide for any asset class for that matter, whether it is gold, equity, or debt, that what is long term and what is short term.
Sure. So, Niranjan, let's talk about equity. You invest in equity maybe directly through shares and stocks, and then you also take a mutual fund route. Why, if you're going through a mutual fund route in equity, you need to stay invested for more than 3 years or more than 5 years, and why is just more than 1 year in shares or stocks? I mean, you can have a longer time horizon, but then obviously due to the tax implications or the tax liability, more than 1 year is long term.
Right. So, as you know, we discussed that to define long term for any asset class, you need to see two, three things. Let's see that for equity, right? And I'm talking about equity as an asset class because risk, whether it is direct or mutual fund, broadly it is same, because if markets go down, your portfolio also would go down, whether it is mutual fund or equity. To some extent, direct equity, depending on how you are concentrated, it could be more risky. But for equity as an asset class, let's see, if you see the risks of making negative returns in equity drastically goes down as you increase your investment period. For 1 year, the negative returns have been around 55%. 2008 1 year returns negative 55%. In 3 years, that number goes down to maybe roughly around double digit 15-20%. In 7 years, it is almost close to 0%. And in 10 years, the minimum returns is around 8-9%. On the other side, the maximum return in 1 year one could have made, or one would have made, is more than 100%. In 3 years, it is 20-25%. In 10 years, it is around 19%. Now, if you see the dispersion or the range between the returns, what you can make or what you can lose, is very high in 1 year, right from 100% positive to negative 55%. On 10 year or maybe 15 years, it is as low as 19% to 9%. And most importantly, it is on the positive side. So now, from a risk perspective, if you stay invested in equity for a longer period of time, then the risk is lower versus the compared to volatility, and returns are slightly in the narrow range, which means your experience in equity over long term would be better. Now, basis that, 10-year is probably a period where you can define that as a long term for equities. The other point is, what is, you invest in equity to do what? To beat inflation. Now, taking this example ahead, if you look at what is the probability of you beating maybe 10% returns in equity in long run, which is 10, 15 years or 20 years or beyond 10 years, the probability is more than 85-90% that you will make more than 10% returns. If you take just inflation, maybe more than 7% returns, the probability of you making more than 7% returns is almost 99% or 100%, looking at the past returns, of course, in 10-year or 15-year period, which probably explains that for equity, whether you are investing in mutual funds or through mutual funds or direct equity, provided you are able to pick the right stock, the long term is basically somewhere around 10 years and beyond. We should not extrapolate short-term returns and define that this becomes a short-term because last 3-year returns are good. Because we have seen when the short-term returns are good, maybe 3 or 5-year returns are good, we probably borrow future returns, and we are actually earning those returns today. But in future, from that point in time, the returns do normalize. So basis all these 2-3 factors, I believe 10-year is safely a period one can assume is a long term as far as equity is concerned.
All right, so we spoke about a lot of aspects, but then I also want to understand long term in terms of other asset classes. When you talk about gold and real estate, how can you play the duration game with these asset classes? Or it's not advisable to do that, because if you have an investment horizon, just stay put in it.
Right. See, for gold, again, people do look at gold as a safe asset class, but it is not. It has probably lesser volatility than equity, but it does have volatility. We have seen gold also, giving negative returns over a 3-year period. Today, as we speak, if you see a 10-year return of gold is around 6%, which is lower than the inflation, it is not beating inflation. So gold also as an asset class will have cycles. But even for gold, I think so, the long-term definition basis how we did for equity, it comes somewhere between 5 to 10 years because it has volatility and one should look at 5+ years. As far as real estate is concerned, it's a very different asset class. First of all, very few people are or rather look at real estate as investments, or one should look rather investment real estate as an investment, because there are multiple things, how the liquidity is there, which area you are buying. So real estate investing is a bit complex. As far as long-term definition in real estate is concerned, I probably think it is much more or beyond 10 years. It is much higher than equity. That's my personal opinion.
All right, so it's very important to analyze what is your preferred time horizon, align it with the investment instrument that you want to invest in, figure out the short-term and long-term risk involved, and accordingly place it in your financial portfolio. Thank you so much, Niranjan, for being on the show and helping our viewers with this today. Thank you.
Thank you.
Let's dip into a short break, but then post that, let's help you making an exit strategy from a particular stock after this break.